The more debt and debt service you have, the less money you can spend out of your income. So as it rises, right now for the US government, it's almost $1 trillion a year that goes to interest payments. It's sort of like plaque that narrows that, and it's a problem. There's also a supply-demand issue for credit, like every other market, so that when we have a large deficit, and now the deficit's projected to be about 7.5% of GDP, when you run a large deficit, you have to sell debt to do that. And the quantity of debt sold has to come up against how many buyers are there. And when I calculate it, the quantity of debt to be sold is much greater than there is the buying power, the inclination to buy. So that's the second thing. The debt service payments, having that problem, the problem in terms of the supply demand. And then you get into a dynamic when it gets bad, and that debt service, you can have selling of existing debt. And that's when you have real problems. Now, in the private markets, credit markets, we just talk about a debt-death spiral. And a debt-death spiral is that part of the cycle when the debtor needs to borrow money in order to pay debt service, and it accelerates, and then everybody sees that and they don't want to hold the debt. That's where we're approaching.
How soon before we get there then?
It's like if I was a doctor and I was speaking with you about your condition, I would say to you, this is now very, very serious. All of these are major problems. What you need to do is cut your deficit from about 7.5% of GDP to 3% of GDP. And you can do that. There are certain things that you can do that cut it in a certain way that'll make it much healthier. So the real problem is a political problem. So we could get into the mechanics of how that was done. It was done in 1992 to 1998 as an example. And it can be done, and it would be good for the bond market. It would be good for everything. But you have to keep in mind 3%. In other words, it's what I call the 3% solution. The 3% solution is that you have to get the deficit down to about 3% of GDP. And then also the important thing is that you can realize that you can get it from 3 factors. We think about 2. There's taxes, there's spending, but there's also interest rates. The interest rate on the debt is very high. And so when you cut the supply, you improve the bond market. In other words, it performs better. You'll get a lower interest rate. And when you get a lower interest rate, that's good for markets, good for the stock market, good for the economy and so on, which brings in other taxes benefits. So if you think about those 3 factors, in other words, I emphasize 3% of GDP with those 3 factors, that can be done. And if it's not done this time, I really worry. I think that everyone who's responsible for that, from the president to the Congress, should recognize, they should take this 3% pledge, but recognize that if they don't get it down to that they are responsible for the consequences that will follow.
So walk me through what we can expect to see next here, and what is your message to the Trump administration, who is responsible for stewarding the US economy right now and managing that debt level when it comes to addressing this problem that you're highlighting?
I'd say recognize the problem, and I think they recognize the problem. And then in the actions that are being taken, how do you cut costs? How do you raise productivity? How do you make sure that the technology gains produce the incomes and the productivity to compensate for that? Make sure that you really know what you're doing and you're practical, and do it on the conservative side, because, how much can the cutting actually be? We'll see. And what are the consequences of the cutting? And each one of those. So you better take a sharp pencil and be conservative. The other thing about this is you have to do it when the economy is strong, because when you have these cuts in the budget deficit, it is think of that as a difficult experience, because it's fiscal restraint. That will be balanced with monetary restraint, because the central bank will ease and the monetary policy will follow. But you need to do this now, is my main thing. Because if you do it another year from now or 2 years from now, you're going to accumulate that much more plaque, and you're going into the part of the cycle which is very, very risky. So, it's a tough job that you've got to do.
So if you're the doctor, where does the scalpel cut first?
I can't tell. Each has a different approach. I think this is the biggest problem. Biggest political problem is they don't have a number in mind. That's why I emphasize 3% of GDP. They don't have a number in mind. And then everybody's got their own particular way of dealing with this. And that's the political problem. So it can be dealt with. I think that if they put together a fiscal commission or whatever way they get to the answer, take the pledge, 3% of GDP that they're responsible for, and then have perhaps a fiscal, whoever is responsible to get there, they have to get there. I don't want to let my own preferences for one thing or another. Everybody's got the preferences and they're not talking about it. That would be like asking me would I prefer exercise, would I prefer diet, would I prefer that? I'd rather not say and leave it to those who figure out how to get there. You better pay attention to what's happening because interest rates, the Treasury interest rate is the backbone of all markets. It's the foundation of all markets and all economies. And we're getting into a period now where asset prices are becoming pretty high. This can look quite like 1998 or 1999 when asset prices rise. Back then we had great new technologies, the internet, the .com and so on that went on to be great. But pricing matters. And so when you have these high prices relatively high, and then you have a rise in interest rates, that can cause trouble. It's likely to cause trouble. So pay attention to actually literally what happens and be careful about that. I would also say that debt assets, in one way or another, probably are not going to be a great asset class. There's a lot of risk in the debt asset. People think of default risk, but there's the money and the devaluation risk because there won't be a default. The central bank will come in and will print the money and buy it rather than to let that default happen. And that's where there's the depreciation of money, the value of money. And so you have to think in real returns, not just nominal returns, and be aware of those risks.
Are you concerned today about valuations that we see in equities?
Yes. And I think I never remember a time in my life where the disparity of returns and necessary earnings growth to justify multiples, that disparity between sectors was so large. The United States pricing and all of that has become very, very large. And within the United States, those tech companies and so on have become very, very large. I'm not saying they're too high, but they may be. So when I'm looking at the pricing disparity, I am concerned. I think there's a lot of enthusiasm by, the stocks that we all know, the Magnificent Seven and beyond that. I think the biggest tech impact of AI will be in the users, not necessarily the producers, to be able to change their cost structures, to be able to have the benefits of the efficiencies and so on. And I don't think they've received anywhere near the adequate amount of attention. So I would rather be in those types of sectors if I'm playing that part. But I'm also, I believe a lot in diversification. I also think that people don't have typically adequate amount of gold in their portfolio. In other words, gold, if you didn't have a view of the market, like the gold market, it's a very effective diversifier under the other portfolio because when bad times come, gold is a very effective diversifier. So I think that having something in the vicinity of 10% or maybe a little more, 10 to 15% in the portfolio is worth giving some thought to. And when I say gold, some people might say digital currency and so on. I own some digital currency. I own some Bitcoin too. But in other words, debt is money and money is debt. And we have a problem. We have a supply-demand problem with it. And so a good diversifier for a typical portfolio is that. We have a lot of people, a lot of the market is leverage long. Everybody wants everything to go up, and then they get excited, and then they get leverage long. And that creates a position that could be difficult. There are these cycles, the short-term debt cycle or the business cycle that
6 years typically.
I described. Yeah. We know what those look like. And then they rise, debt keeps rising relative to income. And the income is needed to service the debt. So the way I view it is after the war, Debts are basically written off. You start with
Clean
your
sheet of
parents.
paper.
My parents didn't have any debt. They didn't have any much. And then they begin the cycle. And it's almost what we talked about earlier. They don't want to spend money. They don't want to get. And in the early stage of the cycle, it's the sound money stage. And the sound money stage can be measured by, first, does the debt create more income than it's needed to pay it back? It's basic.
It's a good use of capital.
Right. It makes everybody happy. I lent you the money. I got paid back with my interest rates. I'm happy. You borrowed the money. You used the money in a way that allowed you to move forward. You came up with the good ideas and so on. Productivity increases and debt is not rising fast relative to income.
Confidence is high. Financial systems are stable.
Yep. The confidence being high starts to be a red flag. So what happens is you're at that stage. And by the way, the monetary systems at that stage are hard. In other words, when we came out of World War II, this is the beginning of the new debt cycle, the new cycle. Gold was there. You couldn't lend more than gold because they had it back and so on. So you had sound money and sound finances and confidence builds, and those who are doing it are making money. The prices go from cheap to expensive. Like I told you, the earnings yield on stocks were twice the bond yield. I mean, like, wow, you could just take the dividends, but everybody was worried about going down. And then it changes, the prices go up, the optimism, and then you come really to getting invested. Asset prices become expensive. You borrow money to do it. And so you have a debt bubble. In other words, you get to the point where the income produced doesn't service the debt. And then you begin a dynamic. It's very simple. As I say, it looks to me like we're in 1998. You know, these all become how extreme. So I have measures, I have indicators like that give it, and it looks like 98. You know, I know that we're over here. And then what happens is that goes on and you see unsustainable debt growth. Now, the unsustainable debt growth that we're seeing right now is particularly the government. The government is going to be in financial trouble. And I'll get into that in a minute. But what happens is you see that debt growth, and then you see a rise in interest rates. This is the classic. And a tightening of monetary policy, put some brakes on, and that pops the bubble. And then you go through the debt liquidation phase. Credit creates buying and stimulation. And everybody wants up. They're going to give you money and credit. It's mostly credit. They make credit available. And then you go take credit. That's how when they lower interest rates and they make credit more available, you get your car, you get your house on credit. Okay. But credit creates debt. So what happens is every time you get one of these, then
A local dip.
they want to give you credit. But it's like giving an alcoholic a shot or an addict. You give them a dose and you get that. And politicians like credit because credit comes before debt payments. So I give you credit, we get in debt, you love me. You know, that's why they want the Federal Reserve and the central government to be separate, you know, to try to do that. But still, what happens is, and that human nature wants the credit, you know? So that's why debt to incomes go like that, you know? If the debt is denominated in the currency that the central bank can print, you always get the printing and you always get the devaluation of money. And then what happens is, then the debt becomes so cheap that it's easy to pay it off. So if you're watching, like Japan is a good example, if you owned a Japanese bond, you would have lost about 80% of your money relative to something stable like, let's say, gold, and you would have lost about 60% of your money relative to a US bond because you got 3% less interest rates and the currency depreciated by almost 4% a year. And that 7% of the year is what you would lose. And then what happens is if you're in Argentina, take it to the extreme, you take that debt and you pay it off because it's worthless. So I'm a kind of those things guy that prefers gold for the reasons I'm going to explain. Okay. But I have some Bitcoin but I've got much more gold. And the amount that I think is a prudent amount, if you look at correlations in the systems and all sorts of things, the least risk amount to have in terms of maintaining your buying power is somewhere between 10 and 15% of the portfolio. Now, on the Bitcoin versus gold, here's the thing. Bitcoin is not a private asset. The governments watch it. They know what you're going to have. They know where you are. They can tax it. They can take money away from it. It exists at their pleasure, and they can do anything they want with you. Their comfort of you being in Bitcoin is better than their comfort of you being in gold, let's say.